As an investor, there are a ton of things that you need to know, especially taxes. Do you know what taxes you need to be paying when you own an investment properties or when you'll be paying them? There are 5 taxes that we're going to be discussing in this video. As an investor, taxes is something you should be aware of and something that your real estate agent should be educating you on. When you're investing in an investment property, it's not just about deposit. It's about deposit, closing cost, carrying cost, and taxes. There are some taxes that we pay at the beginning when we purchase a condo. There are some taxes where we pay through the whole entire time we own it. And there are some taxes that we pay when we sell. First, let's discuss land transfer tax. Land transfer tax is the tax you pay when you purchase a property. It doesn't matter if it's pre-construction or resale. This is a tax you pay when you purchase a property. It's like when you buy something at the store. There are taxes. It's the same thing when you buy a property. When it comes to land transfer tax, there are 2. There is the Ontario land transfer tax. So if you're purchasing a property in Vaughan, Richmond Hill, Markham as an example, you'll only be paying 1 land transfer tax, which is the Ontario land transfer tax. Now, if you're buying a property in Toronto, you'll be paying 2, the Ontario land transfer tax and the Toronto land transfer tax. And you only pay this when you purchase a property, and you only pay it once when you buy it. If you're purchasing a pre-construction condo, land transfer tax is taxed on purchase price minus HST. Why do we do that? Because the government is trying to avoid double taxation. The next tax we're going to be talking about is GST and HST. This tax is applicable to pre-construction condos, new homes, or substantially renovated homes. The good news for investors is that there is a rebate. So how does the HST residential rebate work? Well, at closing, you'll be paying HST. But then what you can do is you can apply with the government to get the HST residential rebate back. And your lawyer can help you with this. One of the requirements that you need is to have a lease agreement for at least 1 year showing them that a tenant is going to be leasing out your unit. And you'll be getting up to $24,000 back. The next tax we're going to be talking about is property taxes. And property taxes are payable through the whole entire time you own this property until the day you sell it. Property taxes are payable each year. And if you buy a condo in the city of Toronto, then you'll be paying property taxes to the city of Toronto. If you buy a condo in the city of Vaughan, then you'll be paying taxes to the city of Vaughan. Each city has its own percentage of property taxes, and you can pay it to the city monthly, quarterly, or semi-annually. The next tax we're going to be talking about is income tax. And as an investor, income tax is based on the rental income you'll be getting annually. That's if you're getting a surplus on rental income annually. For example, if you're renting your condo in downtown Toronto for $2,500 a month and your expenses are $2,000 a month, then you will be getting a surplus, a profit of $500 a month. Now, multiply that times 12 months, you made $6,000 of profit annually. So what you will be doing is adding $6,000 over to your income, and whatever bracket of income tax you pay, you'll be paying that annually based on the surplus that you make on your rental income. The last tax we're going to be talking about is capital gains. And capital gains is due and payable only when you sell your property. So when you sell a property, you add up any profits, any surplus, any money that you make from selling your property. When you sell your property, let's say as an example, you bought a condo in the city of Toronto for $500,000 and then you sell it for $600,000, you made a profit of $100,000. If you incurred any expenses in purchasing this condo, then you would deduct from the $100,000 profit. But if you didn't, then $100,000 is capital gains. And the way it's taxed is that the profit of $100,000 that you just made, half of it, so 50%, which means $50,000, will get added to your income tax to be taxed at your income tax bracket. To learn more about investing and to avoid any surprises like closing cost, carrying cost, or even taxes, contact one of our Platinum agents who will be happy to guide you with all the numbers you need to know when it comes to investing. This has been another G2 Homes exclusive. Remember to subscribe and to visit us at gta-homes.com.